kind of start by just recognizing that, when we talk about healthcare reform, there's a lot to it, and I think we can learn a lot today. But a couple of the challenges that I recognize, or this applies a little bit differently to probably everybody in this room, whether you're just an individual curious about the law, whether you're part of a small employer group or a large employer group. So I hope to kind of be able to discuss kind of the topic in a way that will be helpful to everybody. But there are certain aspects of the law that are obviously more relevant or pertinent to different types of groups or different types of individuals out there. And so hopefully that will be all right. And then the only other thing that I just want to mention is that back in 2010, the spring of 2010, when the law was passed, it was a 2,800-page law. Today it's over 15,000 pages, and it's something that they are projecting will be more than 30 or 35,000 pages kind of at the conclusion of everything. So the other just kind of caveat to the presentation is that it's a lot of information. It's a complicated piece of legislation, and so what we cover today will probably kind of just be scratching the surface in terms of some of the high-level topics and the things that I think will be most relevant to this kind of group and this audience. But there's a lot that you could spend days and days digging into and discussing. So, and then finally, before I just jump in, please feel free to ask questions, even if as we go through the presentation. If there's things that don't make sense that you'd like clarification on, let me know. There is the possibility that it's a question or something we'll be addressing maybe a little bit later in the presentation, and so I'll let you know if that's the case. But otherwise, I want to take your questions as they're kind of relevant to the topic that we're discussing. So don't hesitate to let me know if something's not clear or if we should discuss something in more detail, and we'll kind of go from there. So I kind of talked about the law back in the spring of 2010, passed on March 23rd. A lot of what's kind of taken place and required to take place under the law has already happened. There's kind of staggering effective dates for different components, and so some of the pieces of what's important here have already taken place, whether you realize it or not. And we'll talk about maybe what some of those are. But 2014 is a big year, which I think is kind of speaks to the timeliness of this presentation. Just because 2014, some items taking place on January 1st, other items taking place at the anniversary date or the renewal date of a policy or of a plan. There's a lot that there's a lot that happens in kind of the next year. So we'll talk about some of that, and then actually beyond 2014 into 2015, 16, 17, 18, and beyond. Again, they're staggering kind of effective dates for different components of the law. So to kind of give you kind of a framework to work off of here, and what I'll kind of try to follow as we go through the presentation, is just that when you look at the law, you can kind of break it into maybe three different categories. There's the employer responsibility or mandate to provide or offer coverage. So that's kind of one component of the law. There's the individual mandate to carry coverage for each and every one of us who live here in this country. And then there's benefit mandates, which the benefit mandates for the most part apply across the board to all health plans, whether it's an individual policy, whether it's a small group policy, a large group policy, whether it's a fully insured plan, a self-funded plan, all the kind of different types of programs out there. There's benefit mandates that apply to the actual benefits that are made up within any program. So we'll kind of follow that that line of thinking and talk about what is the responsibility of an employer out there, what's the responsibility now of each individual, and then how do just health plans generally change and are affected by the law. And I will also kind of add one additional caveat that I hope to be able to answer all your questions and go through everything that you'll be interested in. But if you do have a question that I might not know the answer to, because again, this is a lot, then I will make the commitment that I can take that question and go find an answer for you. So we'll kind of jump in and talk about that that employer mandate. You know, when you talk about the employer mandate, you really have to kind of make a distinction between groups that are large group and groups that are small groups. And kind of 50 full-time employees or 50 full-time equivalents is kind of the threshold where you start to think about the difference between what the larger groups are required to do versus what a smaller group is required to do. But I will say that I think it's important, whether you're in one camp or the other, it's important to understand kind of the whole picture, because healthcare is changing pretty rapidly as a result of this law and just other changes within the industry. And it's important for, I think, all of you, even if you're part of maybe a smaller group, to understand what's required of a larger group. You know, what are others in the community having to comply with and think about? What are our competitors being required to do or not being required to do, and how does that affect the way that we think about, you know, our business and our benefits program? And so as we kind of go through this, most of the aspects of the employer mandate are going to apply to those larger groups, meaning you have 50 full-time equivalent employees or more. And when I say full-time equivalents, we're basically looking at how many employees do you have that are working full-time, but also if you're part of an organization where there's a number of part-time employees, you know, how do those maybe add up to a full-time equivalent? We'll talk a little bit about the 30-hour per week and how, for the purpose of benefits, the law changes the definition of a full-time employee to 30 hours per week, and so not 35 or not 40 or anything different, but 30 for the purpose of benefits. So, for example, if you have two part-time employees both working 15 hours a week, you basically have one full-time equivalent in those two part-time employees. So, for the for those employers who are 50 or more part-time equivalents, there are requirements that are quite a bit different than what's in place now. And for those groups that meet those kind of those thresholds and who aren't compliant with the law, there's obviously penalties or taxes that would be assessed to those types of groups. So we'll talk about, you've probably heard kind of just the phrase or the term pay or play. What does that mean? Managing employee hours, minimum essential benefits, and affordable employee contributions. When we talk about pay or play, basically what we're referring to is these organizations either need to pay, and the pay piece of this is $2,000 per year per full-time equivalent. And you do get the first 30 full-time employees free, but beyond that, the penalty for noncompliance is $2,000 per full-time employee per year. And that's also that's a penalty or a tax that for the for-profit organizations that are listening in and interested here, that's an after kind of an after-tax payment or tax in and of itself. So most employers who are kind of thinking about this pay or play option and thinking about the pay component of this are looking at that $2,000 penalty and thinking of it more like a $3,300 or a $3,400 penalty per full-time employee in their organization. So you can either pay and kind of not offer a program or not concern yourself with compliance on your program, or you can play. Play basically meaning you're going to offer a qualified program to your employees and you're going to meet the minimum requirements. And again, simplifying this down, because there's many pieces, but there's really three main tests that any employer out there is thinking about in terms of avoiding or steering clear of these penalties. The first is that the program has to be offered to any employee who's working 30 hours or more per week. So right now there's potentially plans that have a kind of a minimum eligibility requirement of 35 hours per week or 40 hours per week, or maybe just for all full-time employees, and the definition of a full-time employee is kind of defined by the specific organization in question. Again, that definition changes with this law to mean any employee working 30 hours or more per week. and employers need to provide the coverage, offer the coverage to all of those employees who are doing that. The other thing is that you have to offer kind of a minimally qualified program, and there's a couple things that go into that. One is that you have to provide in your plan all of the minimum essential benefits, the essential health benefits, and that's a long list of things that that are kind of required or essential or kind of standard under a typical health program. But those need to be offered. You can't exceed certain deductible levels or out-of-pocket maximum levels, which I'll talk a little bit about as well. And then you also have to have a plan that has at least a 60% actuarial value. And so when you talk about actuarial value, basically what we're looking at is if you consider all of the benefits or all of the claims that are going to be eligible under a program, the plan needs to cover at least 60% of those costs. And the plan participant, through their out-of-pocket expenses, deductibles, co-insurance, co-pays, they're not going to be able to essentially account for 40% or more of the cost under the program. For the organizations out there who are on kind of traditional fully insured plans, it's really the health carrier, the health insurance company, who's kind of ensuring compliance on this on your behalf. They're going, on a going forward basis to for the most part, going to be offering plans that kind of meet those minimum requirements, so that you and they are not, not falling out of compliance and at risk of paying penalties and things of that nature. For self-funded programs, that's something that you have to monitor a little bit more closely. But that said, your agent or your benefits consultant is someone who should be, well on top of ensuring that you have kind of a minimally qualified program. And so, anyways, you want to do that, and then the last thing is the affordability piece. And the affordability piece is something where, if you kind of follow the stream of thinking on this, basically what the law is wanting or requiring of employers is to offer a plan, offer a good plan, and offer a plan that's affordable. I'll put that in quotes, affordable to to the plan participants. And basically the way that's defined in the law is that somebody shouldn't be paying more than 9.5% of their income for their benefits coverage, for their health insurance coverage. And so there is a safe harbor that's been added to this to make this kind of more manageable for an employer thinking about this piece of the puzzle, and that's that what you charge or require the employees to contribute for the single coverage should be more than 9.5% of their wages with your organization. And so that's kind of the easier way to think about that. Otherwise, you don't necessarily know if somebody has family members and what someone's household income. And so again, the simplest and the easiest way to think about this is we don't want to be charging more than 9.5% of somebody's wages with us for what they would pay for single coverage under our program. So if you're meeting those kind of three basic tests, those three basic requirements, you're in a pretty good position in terms of steering clear of the pay or the penalties that might come about. If you're not offering your program to all of the plan participants who are working 50 or 30 hours or more per week, or if you're not offering a minimally qualified program, then you will pay that $2,000 per full-time employee minus the first 30 in your company, in your business, in your organization. If you're offering a program that meets those requirements, but it's not an affordable program, meaning you're charging more than the 9.5% of wages for that coverage, or requiring your employees to contribute more than 9.5%, then what happens is that if that individual goes to one of the health insurance exchanges, which we'll talk about, but goes to a health insurance exchange, buys their coverage there, qualifies for a subsidy, etc., then you will be assessed a $3,000, again, after-tax penalty or tax for that one individual who you were charging unaffordable contributions to, and they declined your coverage, declined your program, and went to one of the exchanges and purchased there. Yes?
Just a question, but that 9.5%, does that include their spouse's income too?
So again, if you think about the safe harbor, which is what I would encourage you to do, then it would not include the spouse's income. It would just include their income,
Oh, okay.
and it would also just be what percent of their income are you charging for single coverage, even if they have dependents on the plan, even if they have a spouse or children on the plan. What would you charge that individual for the single coverage? And that's going to need to be less than 9.5% of their wages with you. Yeah, and along the lines of that question, I will say that the law requires employers that offer a program to offer dependent children coverage, but it does not require employers to offer coverage for spouses. So one of the options that's a completely legitimate option under kind of the structure that's been put in place is that you offer coverage to employees and to their dependent children, but you don't necessarily have to offer coverage for spouses. Kind of the other way of thinking about this is you want to be aware of what you're charging on that single coverage, and what that is a percentage of someone's income. But you can charge whatever you want or require contributions, whatever you'd like, for dependents, spouses or children, up to the full cost, meaning that you could obviously subsidize the cost of the coverage for the employees, but if someone wants to enroll dependents, you're completely okay charging up to the full cost of the dependent coverage for children or for spouses. So really good question, and I think there's a few things to consider on that. So we talked about the full-time equivalents. We talked about the 30 hours per week. One of the things, and I won't spend a lot of time today kind of thinking about solutions, if you will. How do we move around these types of things? But one of the things that I think is important for any employer to consider is managing full-time employees' hours. And one of the things that we do see is that we do see some employers getting very particular about how many hours their employees are working, because again, health coverage is a big expense, and if you have populations of people who have not previously been eligible or covered under the plan who are going to be becoming eligible, you at least need to be aware of the potential cost involved. And one of the things that that is being done is hours are being managed very proactively. Just as kind of a definition here, that 30 hours per week, and the way you count how many hours per week someone may be working is all of their compensated time. So if it's compensated time, it's work time in essence. So that will include vacation, sick leave, things of that nature. And we'll talk a little bit about if there is anyone here who comes from a large organization or an organization where managing that hours, because you have a lot of variable hour employees, seasonal. Yeah.
On
Yep.
the seasonal aspect, if you have employees that are working less than 30 hours most of the year, but then seasonally they bump up to full time, does that mean they would be covered?
This 120-day piece is kind of where that would kick into play. If you're considering eligibility kind of just on a rolling basis, kind of like most companies think of this now, then you're going to want to think of those employees and say, are they working full-time hours for more than 120 days? And if yes, under kind of an ongoing kind of rolling eligibility practice, they would become eligible for the plan. But if it's a shorter period of time, if they're doing this for a 1 month period of time, holiday season or something like that, then that's not necessarily going to trigger their full-time status.
So it's full-time for 120 days.
Yeah, or however you internally determine eligibility, as long as it meets at least that requirement, it could be stronger. So you may, as an individual organization, think about this and say, anybody who works, full-time for 30 days or for 60 days in our company, in our organization, is going to be at that point in time eligible for benefits. And then that would be on a case-by-case basis. But you at least have to meet kind of these minimum requirements in the way you think about it.
Chris?
Yes.
So, if I've got an organization that has 5 full-time employees the whole year long,
Mhm.
and 120 employees that work 25 hours a week, what am I required to do?
So the way they look at this is on an annual basis, and what happens when they would come and audit, potentially a company to determine if they are large or small and meeting the requirements, is they're going to take your average enrollment.
Questions, repeat the questions for those that are remote.
Oh, fantastic! Yeah. So the question is, what happens if I'm typically a small employer, have just maybe 5 full-time employees, but I have a particular time during the year where I bump up and I have 100 or 200 full-time employees. So, anyways, the way they look at this is they take your average enrollment for each quarter of the year on a systematic basis. Meaning, if you're looking at this January 1, you're going to look at it. What's the enrollment on January 1? What's the enrollment on April 1? What's the enrollment on July 1? And so on and so forth, and then take the average of those numbers, and that's how they're determining for the course of a year, is a particular employer going to be considered large or small group.
But if on a full year basis, everybody is restricted to 25 hours a week, such that they don't meet the 30-hour rule, but when you add up all the part-timers, you're in a large employer group.
Yep.
And there's nothing seasonal about it.
Yep.
It's all year long.
Yep. So a little different scenario. Again, the question on this is, you have a lot of part-time employees without any or very few full-time employees. It's an interesting thing, because the way that you're going to be determined whether large group or small group is on the full-time equivalence, meaning that if you have hundreds of employees working 25 hours per week, you're going to be considered large group for the purposes of the way you think about this. But when then you go back and think about the actual penalties that would be assessed, the penalties are assessed only on the true full-time employees. So you bumped yourself into a kind of a large group camp, but you're still in a relatively safe zone if that truly is your situation, because when they go and they look to assess the penalties, they're going to assess the penalties based on the number of true full-time employees that you have, which in that scenario you don't have any, or you have very, very few. And so it's something you want to be careful about, because in the eyes of the federal authorities, you're going to be seen as large group, and you're going to be subject to the reporting requirements and so on and so forth. But when they actually look at your program to assess any penalties, if it's even a need to do that, then you're not going to be in a position where you have penalties that are due on your program. So thanks, Greg. I want to talk just really briefly about the look-back period, because I think this will probably apply to relatively few who are kind of listening in. But part of the challenge on this is when we redefine the definition of a full-time employee for benefits purposes, it's a big deal, because one, it's changing the way you consider your employee population. But two, if you're doing something wrong at a new level, even now there's penalties and there's fees and there's some exposure and risk from a cost standpoint. And so one of the things that was added to the law was the opportunity to consider your eligibility with a look-back period. And again, this is going to probably be for the larger group, or probably going to be for the group who has a lot of kind of variable hour employees or a lot of seasonal type situations. But in order to kind of keep yourself protected and safe in doing something that you don't mean to do, just because you got people kind of jumping around and those types of things, there's the opportunity to implement a look-back period, which can be as short as 3 months, as long as 12 months. But what the look-back period does is it takes a period of time looking back, and it determines everybody's eligibility in the organization and on the program based on the average number of hours they worked over a period of time that you specify. So say 6 months. You're looking at 6 months worth of time. Maybe we're talking January 1st, 2015. So you're looking at July 1st of 2014 through the end of that year. And you're averaging all of the employees' hours over that period of time, and you're making a determination about whether those employees meet eligibility because they've worked at least 30 hours or more per week or haven't met eligibility. And then what's important to consider with this is that there's a stability period on the front end looking forward that's at least as long as the look-back period, and a minimum of 6 months. So again, you take that same example of looking back 6 months to determine eligibility. You basically have a 6-month period of time looking forward where the individuals in the organization are either locked into eligibility or locked out of eligibility. So somebody who is working part-time and starts working full-time, that's not important because they've been locked out of eligibility for a 6-month period of time. And vice versa. If somebody's been deemed eligible, they're eligible for that 6-month period of time, and they can't be pulled out of the plan or lose their eligibility, even if they drop their hours to kind of a part-time work status. A 12-month look-back period is the most common because it keeps things the most simple in terms of looking at the full calendar year or the full plan year. But again, it's important because you don't want to be stuck in a situation where you have somebody who was working part-time and then who begins working full-time, and because you're a larger organization or because this is a common occurrence, you get stuck or caught with having not had somebody eligible that should be eligible under the law, and now you have penalties to pay on your entire population. This eases the administrative burden for these companies to look at eligibility on a less frequent basis. But the important thing to realize is, again, you're locking individuals in or out of eligibility for a similar period of time. So kind of a different concept, probably a little bit confusing, but for some organizations this will be incredibly critical to think about and incredibly critical to implement, just based on their working population. On all of this that we've kind of considered for again the employer mandate portion of things, this is the piece of the law that about a month ago was delayed 12 months. So this originally was set to go effective January 1st, 2014, and if you remember, about a year ago, the Treasury came out and announced the delay of this until January 1st, 2015. Kind of stating the complications with the reporting requirements and whatnot that this is requiring businesses to comply with, and the need to add some additional time to that. So I think it just speaks to the kind of to the fact that this law is a constantly moving target. That's just one kind of piece of evidence that this is evolving and changing in many ways, and that's how you get from 2,800 pages to 15,000 pages, is because there is a need on an ongoing basis to clarify, to define, to add, kind of rules to the way things that that are mentioned in the law need to be actually carried out and implemented. And because it's a federal law, you have the federal agencies that oversee the implementation of the law, being the IRS, Health and Human Services, and the Department of Labor. And it's these three agencies who are again, clarifying, adding definition and rules to the implementation of what was in the original law itself.
One question from Steve is wondering, how does this affect multiple companies under common ownership?
Yeah, really good question. Yeah, really good question. So the question is, how does this affect multiple companies under common ownership? There are common ownership laws currently under benefit law that talk about whether multiple companies under common ownership need to be considered as one group or multiple groups. And the rules around that are fairly complicated, but to simplify it, you're basically looking for majority ownership across multiple groups or multiple businesses. If it's a cluster of businesses that to this point in time and going forward are seen as commonly owned, commonly controlled, then all of the rules apply to that group of companies as if they were one. Meaning, if you have 10 companies that have 10 employees each, the federal agencies again are going to look at that group, and because of the common ownership, they're going to consider that a group of 100s and a large group and someone who needs to be compliant with the different laws. But there are situations where there's common ownership between companies, but that don't meet the current definition of common ownership under benefit law. Meaning you might have somebody who has a small stake, a 5% stake in one company, a 10% stake in another company, and those two companies are going to be seen as separate under the Affordable Care Act. So, but it's an important question because because all of this will apply to the group as a whole if those common ownership kind of definition is being met. We talked about the minimum essential benefit, and again, the purpose of this being you offer a program, a good program at an affordable cost. They're trying to plug the loopholes in terms of, okay, we're an employer that offers a program, but it's a $20,000 deductible plan, and it's not doing a whole lot of good for anybody. But we're offering a program. It's got to be a decent program, meeting the minimum requirements, and it's got to be an affordable program. Again, plugging kind of the hole where some employers would think about, okay, we'll offer a plan, we'll even offer a good plan, but we'll just have the employees pay 100% of the cost. Again, the purpose behind this is that everybody has access to affordable coverage, and so all three of those kind of basic tests are to be met.
So
Yeah.
Chris, can you have a sliding scale based on 9.5% of their income?
You absolutely can. So the traditional way about thinking of employee contributions is just taking your traditional tiers and saying, singles are paying 25%, singles and spouses are paying 35%, so on and so forth. But what we are seeing is a trend to this type of arrangement where the employee's contribution is based on a percentage of their income. It's a way to stay safe in essence, because otherwise, what you have to do is you have to say, okay, what are we charging for the coverage? Take the single coverage. Okay, what are all of our employees that are meeting the full-time definition? What are their wages? And what's the lowest paid person who? Wouldn't you love to be this person, right? There's one in every group. The lowest paid person who's still meeting the full-time definition. Where's that person at? And we have to charge that person less than 9.5%, and thus everybody else less than that number. And so they move to kind of a sliding scale where we're going to charge everybody 6% or 8% or 9 or 9.5% of their income. That way we're compliant with this, and we also have a kind of a way to manage costs where if otherwise we had to lower our contributions and reduce the revenue we're taking in from those employee contributions. And so it's something that's being considered and implemented by many groups now. The one thing, and I see the question back here, the one other thing that I'll mention here at this point is you can't do the opposite of that, or you can't do something that represents the opposite of that. Part of the Internal Revenue Code, Section 105H, that's been around for 30 plus years, is some discrimination rules about not discriminating in favor of the highly compensated within an organization. And part of what healthcare reform has done is they basically said this is something that hasn't been enforced since basically it was it was put into the Internal Revenue Code. And there are many groups who are out of compliance or again, discriminating. It's a harsh word, but discriminating against the lower income of the organization. And so healthcare reform has in it that this will be now enforced starting in the year 2015, meaning you can't, from a benefit standpoint, you can't discriminate in favor of the highly compensated. Let me give you an example of how this sometimes plays out. You have a management carve-out plan, or you have a program that's only made available to the executives within the organization, or you have the same plan that's available for everybody, but management gets it at a lower cost than your hourly workers. These are all situations that honestly, if you ran a discrimination test, and I'm not talking about discrimination against protected classes, age, sex, religion, these types of things. I'm talking about the income discrimination piece of this. Those plans would probably fail that type of testing. And that's going to be enforced going forward, and the penalties are significant. So what you can't do, and what you need to consider going forward, is that you basically either offer the same benefit plan at the same cost to all employees within the organization, or if you're doing something different than that, it is well worth your while to have a discrimination test run to make sure that again, you're not favoring the highly compensated within the group. And there's differences you can have. You can have a better deal for those that have been with the company for a longer period of time than new hires, as long as, again, when the discrimination test is run, it's not kind of determined that all of your low-paid people are the new hires, and all of the people that have been there forever are the highly compensated. You would fail the test even with that type of arrangement. So you can have a sliding scale that requires the highly compensated in the group to pay more, but you can't have an arrangement where the highly compensated would be required to pay less than those who are going to be considered the lower compensated employees. Make sense? Yeah. Yes?
I have a couple of questions, but I'll ask you to discuss it.
Okay.
If an employer offers a qualified affordable health plan, is the employee or their spouse or their children disqualified from going to an exchange? If they do go to an exchange, does the employer still get charged with $3,000 penalty? And if the employer only offers what's the minimum requirement, like for example, an employee and with children, is the spouse disqualified from going to an exchange? How does that work?
Okay, really good question. So the question was, if the employer is offering a qualified, affordable plan for an employee, would that make a spouse or dependent children ineligible to find their coverage on an exchange? And the short answer is no, not necessarily. We'll talk about the exchanges, but any employee is going to be ineligible for the exchange if they are being offered a qualified, affordable plan through their employer. If it's not that as the case, if they're not being offered a qualified, affordable plan through their employer, then they would be eligible for the exchange. But the same kind of thinking lies in eligibility around spouses or dependent children. Meaning, if a spouse or a child is offered affordable, qualified coverage under a group plan, they're going to be ineligible for an exchange. But if, for example, you have an employer like the one I mentioned earlier who's decided they're not going to offer coverage for spouses, or they're going to offer coverage for spouses, but they're going to charge them, the full amount and something that's going to be not necessarily affordable, even though they can do that and that they're not at risk of penalties by doing that, then those spouses would be eligible for the exchange. So you can have a situation where a dependent spouse or dependent children are eligible for an exchange and the employee is not eligible for the exchange. Absolutely. So, and we'll talk we'll talk very briefly here, or shortly here, about those exchanges, and I know exchanges are kind of a hot topic, and everyone hears about them, and what are they, and how are they going to work, and we'll talk about that. But hopefully that answers the question okay. Before we jump into the individual mandate, we've talked a lot about the employer mandate and the penalties and the pieces that employers need to be thinking about and compliant with. We'll talk real shortly here about the individual mandate and how that affects groups and employers, but also really how it just affects all individuals. Before we do that, I'll just mention very, very briefly, this is just a really exciting thing. If you don't do it right, you're taxed and penalized. If you do it right, I hate to tell you, there are still taxes and penalties on all health plans. Again, there's a lot of I don't want to put it that way, but there are a number of taxes and fees that are implemented as a result of the law. I'm going to talk about the three that are relevant to employers, but there are in other industries and other sectors, pharmaceuticals, medical providers. There are other things to be considered. But for those that are part of a health plan, and for those that are offering a health plan inside of a group, there are three fees that will go effective in 2014. One of them applies only to fully insured programs. One of them applies only to self-funded programs. And then one of them applies to all programs, fully insured, self-funded, large group, small group, individual plans, everybody. So the one that applies only to fully insured programs is the health insurance industry fee. It'll go effective next year, 2014. Because you're fully insured, this is something that the carrier will basically be passing along in terms of a rate increase and a cost to you, but they will be the ones that are paying this on your behalf. But it starts at 2.2% in 2014, and then again on kind of a staggering timeline, it increases to 4% over time. And so that's just something that's going to be built into all of the fully insured rates on programs starting next year. The fee that only applies to self-funded plans is the PCORI fee, and this is a fee that self-funded plans start paying this year or next year, depending on the renewal date of the plan. But it's $1 per plan participant per year in the first year, and then it increases to $2 per plan participant per year in the second year and beyond until 2019 when it goes away. And this particular fee is there was a committee put together out of the law to research cost effectiveness in healthcare. One of the challenges we have in healthcare is that medical inflation has been rising at about 7 to 10% per year for over a decade, and that just keeps continuing, kind of year in, year out. You're familiar with this because you see your health insurance premiums going up, at about that rate every year. That's a challenge. I mean, that's 3 times the rate of regular inflation in most years, and that's increasing at a rate that most businesses' profits aren't increasing at, and definitely most employees' wages aren't increasing at. So anyways, the purpose of the committee is to research cost effectiveness in healthcare. Hopefully they do a fantastic job and come up with all the solutions for us because it is needed. But the fees through this PCORI tax go to fund the research of that committee. And then the transitional reinsurance assessment fee, this is a fee that gets applied to every single health plan. Again, fully insured, self-funded, group plan, individual plan, everybody, every plan. And it's a good amount of money. In 2014, it's $63 per plan participant per year. And so you start to think about an individual, even on an individual policy, there's going to be $63 that's passed along or part of the premium that goes to pay this particular fee. If you're a family of 5, that's $63 times 5. for the year. And on a group plan, again, we're talking about participants. So if you have 50 employees on your plan, you don't need to just think about that, but you need to think about dependents. And maybe you have 150 total plan participants, and this is $63 per member. And so this is paid in 2014. The purpose of this and the health insurance industry fee is to kind of assist in the transition that we're making next year, where you have policies that are going guarantee issue. So in the past, an insurance company could deny somebody a policy. That won't be the case going forward. And so you start to think about right now the uninsurable pools, and they have health insurance pools for the uninsurable, and just these pool, just folks out there who haven't been able to purchase insurance, who are going to be coming kind of into the system, into the program. And the purpose of raising these dollars here is to kind of buffer the impact of that and what it's going to do to rates and to everything else. And the goal is to raise $25 billion over a 3-year period of time. So in 2014, they're looking to raise $12 billion with this fee. In 2015, they're looking to raise an additional $8, and in 2016, they're looking to raise an additional $5 billion. And so the $63 will be reduced in 2015, but we don't know to what yet. It will depend on what's needed to meet these funding requirements. But it will probably be reduced to somewhere around $45 per member per year. And in 2016, it will probably be reduced to about $25 per member per year. And then it's supposed to go away. So, the transitional reinsurance assessment fee, again, all plans, if you're on a fully insured plan, an individual or a group plan, this will be built into your rate starting next year. And if you're on a self-funded plan, this will be something that by the last day of the year that you pay, and make sure that you're in compliance with. So there are some taxes and there are some fees that are going into effect next year on health plans, even for again those of us that are meeting the requirements on the pay or play piece. So. Okay, I said we're going to talk about individual mandate. We'll talk about the benefit mandates and then the individual mandate. So the benefit mandates pretty much apply across the board, and this is, I think, a really important thing. If nothing else out of this discussion, hopefully you learn some things so that you're not surprised. And that's kind of one of our major goals is you can't avoid everything, you can't fix everything, you can't make anything that doesn't appeal to you go away. But we don't want it to be a surprise. And those taxes and those fees are hopefully one thing that if you didn't know about, you'll be aware of, and they won't sneak up on you and surprise you next year. The benefit-related mandates are another piece. Many of the benefit-related mandates have already taken place. So you're familiar with plans now allowing dependents up to the age of 26 to remain on the plan. That was part of health care reform, and that was one of the benefit-related mandates that went into effect a few years back. You're probably also familiar with maybe like the lifetime maximums on plans going away. So that's already happened on all plans. There's not a lifetime maximum benefit anymore, where there used to be on most plans a lifetime maximum benefit. 2014 is a big year, and here's a few of the pieces that that will take effect in 2014. One is that pre-existing condition limitations go away. So on most plans to this point in time, when you go onto a health insurance plan, you don't have a pre-existing condition limitation as long as you've had continuous coverage. And typically it needs to be at 12 months of continuous coverage without a significant gap. And if you met that requirement, you don't have a pre-existing condition. But somebody who's coming from kind of an uninsured position to a health insurance plan, they're going to have a pre-existing condition limitation, meaning that if they do have pre-existing conditions, those typically aren't going to be eligible or covered under the plan until they've met that 12 months of coverage requirement. That goes away in 2014. It's already gone away for dependent children. That happened a couple years ago. It's already gone away for dependent children, but this goes away for adults and everyone in 2014, meaning that when you go onto a program, regardless of whether you are insured or not, and regardless of whether you have pre-existing conditions, those will be covered, and there's not a limitation, which is a great thing. But again, in kind of the effort to avoid surprise, this is also potentially a costly thing for not only the industry, the healthcare industry, but for a group plan. Particularly if you start to think about a self-funded plan, and are there going to be some pre-existing conditions that covered on that? And if you're fully insured, same thing. But again, this will be built into what the health insurance companies are projecting and anticipating in terms of increased cost. One of the other things is that waiting periods have to be reduced to 90 days maximum. And so right now, if you have a waiting period greater than 90 days, so if you have a first of the month after 90 days waiting period, or if you have a 6-month waiting period, or there are some plans out there, probably pretty rare, but they'll have like a 12-month waiting period for their plan. Those have to be reduced to 90 days maximum, the day that somebody's at the 90-day point. And if that's not met, if you're beyond that, then it's a $600 per employee tax for having a waiting period that exceeds the 90 days. So won't affect you if your waiting period's shorter than that, but if it's longer than that, definitely something to be thinking about now and be aware of. And then automatic enrollment, this is for larger groups, but it essentially is trying to move us to kind of the 401k retirement plan model where, again, you kind of have an opt-out type arrangement as opposed to an opt-in, which a lot of it's just kind of, the words you're using, but you're wanting employees going forward to actually be declining or waiving coverage, in a written statement. Yeah.
Does it specify, if you have multiple plans, does it specify which one you have to automatically enroll in? Can you do it in the cheapest one, or can you choose to enroll in the most expensive one?
That's a great question. I'm not 100% sure, but I would imagine that you can't enroll them in the most expensive one. That the automatic enrollment would be in the base plan, if you will. That said, the best practice on this is if you require every single employee and every single new hire to actually make an election. I'm either enrolling in a plan, and which plan am I enrolling in, or I'm declining or waiving coverage. And you collect that from every single person because that's going to keep you safe and that's going to keep you protected as an employer. And it's going to be something where every single person's given the opportunity to get what they want. But I'll check on that. I would guess the base plan, but I'll have to look into it. Yeah, good question. Oh, okay. We talked about some of the changes to dependent care eligibility, benefit requirements including unlimited lifetime annual maxes. So lifetime maximums have already gone away on all plans. Annual maximums go away starting next year. So most plans, again, they still have an annual maximum benefit of $1.5 million or $2 million or whatever the case might be. And that has to go away starting next year, which, again, an increased benefit that's going to come with some increased cost. I have one client who there was a member of their plan last year who incurred over $4 million in claims. Now that's not the typical kind of everyday scenario, but it's something that happens from time to time and here and there. And what happened in that particular instance, just to give you some insight, is that plan, that particular program, like really all plans, had an annual maximum benefit of $1 million. So the plan paid $1 million, and the additional $3.3 million in cost got transferred to Medicaid. Medicaid picked up the difference. Just thinking about that same exact situation next year, that would be a $4.3 million cost to an insurance company that in the past was only $1 million cost to an insurance company. So it's a nice thing to not have those annual maximum benefits in place. At the same time, there is going to be some allowance made on pricing for the fact that you do have these $1 million claims here and there, or $2 million claims here and there, or $4 million claims here and there. And so, again, I just want to give you a sense. There's a lot of talk right now about what are rates doing, and for the most part, rates are going up. And next year will be a year where rates could go up fairly significantly because of many good things, but because of many things that are costly to plans and to the companies offering these plans. The only other thing that I'll mention really quickly about rates is just that in many states, small group rates, small group fully insured rates are age-banded rates. And you're probably familiar with this. You've probably seen this. But when the insurance company bills, they're billing based on the plan participants and how old they are. Part of healthcare reform is that goes away in the states where it hasn't already gone away, and that we move to a community-rated type pricing arrangement. And that is going to cause a lot of pricing differences in the year 2014. That if you haven't already heard from your insurance company or your benefits advisor, you should ask about this, because the fact is that there are some groups who this maybe won't affect a lot. But simplifying it, if you're a young group, you got a lot of young employees within your group, the community rating is going to significantly increase your pricing starting next year. The opposite is also true. If you have kind of a above average age within your population, you could actually see some fairly significant decrease in your pricing starting next year. Utah is a state that currently is doing age banding rating and is moving to the community rating next year. There are many states that are already doing community rated pricing, and this won't have an impact. But again, if you haven't yet kind of looked at your age or got some indication from your benefits advisor or the insurance company that you work with, I would ask the question, because you don't want to be surprised with something very different from what you have right now. Yes?
On the annual minimums, are they going to wait for dental and or just medical?
Just medical. Yeah, just medical. And the other thing that's happening on medical plans is that you have the minimum essential benefit requirement we talked about, but they're also putting caps on the deductibles and the out-of-pocket maximums that you can have on the medical plans. And so, in 2014, the caps on the deductibles only apply to small groups under 50. But if you're a small group, you can't have a deductible of more than $2,000 per single or $4,000 per family. If you're currently a small group with deductibles that are more than $2,000 a single, $4,000 per family, that is going to change next year. You're going to have to move to a different plan. In fact, most of the insurance companies are revamping the plans they have available next year, where the plan you're on this year might not even be available next year, because they're trying to again, offer compliant plans. And then on the out-of-pocket maximum, this applies to small group and large group, but you can't have out-of-pocket maximums that exceed what is currently the qualified high deductible plan or health saving account plan annual maximum. So in 2014, it will be $6,350 per individual and $12,700 per family. But again, if you're a small group or a large group, whoever you are, if you have right now an out-of-pocket maximum on your plan that exceeds $6,350 per individual or $12,700 per family, that will have to change. But the requirements are all around the medical coverage. If you have dental coverage within your medical plan, which isn't very common or very often, then because it's part of your medical plan, it will have to meet the same requirements of the medical plan. But for the most part, dental coverage is a separate plan and a separate election and so on and so forth. Really quickly, you've probably heard about grandfathered plans, and basically what happens is that there are plans that are grandfathered because there haven't been significant changes that have been made since the law was signed in March of 2010. And then many plans are now grandfathered because they have, have made changes that have caused them to lose their grandfathered status. But there are a number of things in the law that grandfathered plans don't have to comply with until they lose their grandfathered status. And the major one is surrounding preventative care and how that's covered, but there are a few other things. And so anyways, if you're a non-grandfathered plan, you've already experienced this. If you're a grandfathered plan, at some point in time you'll experience this because either you are making changes to the plan that will cause you to lose your grandfathered status, or in 2018, all plans will lose their grandfathered status and have to comply with all aspects of the law. But one of the biggest pieces of this is that preventative services for non-grandfathered plans have to be covered at 100% without any cost sharing. And this is just kind of a comprehensive list. We won't take the time to go through it, but you have to cover preventative care at 100% without any cost sharing, and you have to cover everything under preventative care as defined by the law, which again, kind of a comprehensive list here, but it's typically more services or more that's being covered than would be covered under a kind of traditionally under a preventative care benefit. And so, anyways, the way you lose your grandfathered status is you either make benefit plan design changes that exceed certain thresholds, or you change your employees' contributions and increase those that would go beyond certain thresholds. On the contributions, right now, just as an example, if you're charging 75% employer paid and then 25% employee paid, and you change that by more than 5%, so you can increase with inflation and things like that, but if you change the split between what your employees pay versus what the employer pays by more than 5%, so you go to like a 35-65 type arrangement, then you lost your grandfathered status, and you need to start complying with this piece. On the benefits, if you change co-pays by more than $5 or other benefits by more than 15% plus the medical component index for inflation, then you lost your grandfathered status, which right now it's kind of hovering around 25%. But if you have a deductible that's $1,000 and you increase that to more than about $1,250, you've basically exceeded the change that you can make without having to lose your grandfathered status. So you probably heard that. I thought I'd just throw that out there in terms of understanding how you keep your grandfathered status, how you lose your grandfathered status, and then one of the major pieces in terms of if you're non-grandfathered, what that means and what's required, and this is kind of it right here in preventative care. Any questions? Okay. Okay, so I'm going to talk about the individual mandate, which I think is relevant for everybody. So whether you're here as part of a group or just on your own, this is relevant to you. And for employer groups, I think this is very relevant because this is what your employees are up against in terms of needing to do. And oftentimes I think there's things that you can do to help educate and assist them so that they're aware of their options, or if they make certain decisions around their options, what that might mean for them. But the individual mandate is the portion of the law that it went before the Supreme Court last summer, if you remember, and it was upheld in a 5-4 vote. But it was upheld under some of the tax law and tax codes, as opposed to under the Commerce Clause, which was kind of a surprise to everyone. But it was upheld. It is in place. It does go effective January 1st of 2014. And what the individual mandate requires is that every person that lives here in this country needs to be insured and carry a qualified health plan, qualified health insurance. And they can do that however they choose. They can do that by electing their employer's plan. They can be on a spouse's plan. Dependents can be on a parent's plan. You can have an individual policy, but you need to be covered. And if you're not covered, then there are individual taxes or penalties that you'll pay for not complying with the individual mandate. In 2014, if you elect to not carry health insurance, then you will pay the greater of either $95 or 1% of your income. In 2015, you'll pay the greater of $325 or 2% of your income. And in 2016, you'll pay the greater of $695 or 2.5% of your income. And again, that's if you're not carrying health insurance through one place or another. So when you think about this on the group level, we've talked about the group's responsibility or obligation to offer coverage, have it be affordable, have it be a qualified plan. It is then up to the individual to make their own decision about whether they're going to enroll in that plan, a different plan, or be uninsured. And that's their responsibility, not the employer responsibility. But the individual needs to consider these potential taxes if they elect not to carry health insurance. Yeah. 1 second. Greg.
Chris, how is this penalty paid?
So this will be assessed. This will be assessed at the time the individual files their taxes. So it's actually probably not until early the year after the year that's being considered, and it will be assessed by the IRS. And for most individuals, it will most likely come in the form of a reduced tax return, meaning that if somebody was expecting to receive $600 back in a tax return, but they didn't carry health insurance, then they would have a $505 return, or if 1% of their income is greater, an even less return. And that's when it will be assessed and paid. Basically, at the time you file your taxes, you will declare whether you carried health insurance for the year and had a qualified plan, or whether you did not. And you'll do that for yourself and any dependents that are filing jointly with you. But that's how it'll happen. And there's a variety of ways that they will be kind of ensuring that this is done accurately. Part of it is what you'll be required to provide. As most of you who are part of a group know, one of the requirements now is that you provide the value of an employee's health plan on their W-2 when it's issued. So that's one of the many ways that they'll know kind of whether you were covered under a qualified health plan or not. But that's how it'll be assessed, and that's when it will be paid. Yes.
If a small company currently does not offer health insurance to their employees, when this takes effect, does that mean that a company now needs to start offering it, or they just tell their employees to walk away?
If you're a small group, you're not If you're a small group, you're not required to offer it. You'll basically tell your employees you need to go out and you need to get it on your own. And I'll talk about their options. If you're a large group, it means that you need to start offering it if you're not currently offering it, or you'll be assessed the penalties that we talked about on the group level, and then they'll have the option to go out and get it on their own. You had a question? Answered it. Okay. So this is the individual mandate, and yeah, a few questions over here. Okay.
I had a question on, as far as your employers who currently have their employees go out and get an individual policy, but then reimburse the employee a certain percentage instead of doing a group plan because they're so small. How is that going to be?
If it's a small group, again, their obligation is they can do what they'd like.
Okay, so you can still reimburse.
You can still do it that way, but the employees will have their own responsibility. Sometimes in those arrangements, if an employee doesn't get coverage, they're not being reimbursed anything, or sometimes they'll take the dollars and they'll go out and they won't actually buy health insurance. And so it's just important for them to realize, if that's the arrangement, that you got to be covered. So if you're covered under another plan, great and fine, but if you're not covered, potentially you want to start using those dollars to actually purchase a policy or get a policy, because otherwise you're going to be subject to additional taxes and penalties, which increase over time. And honestly, I don't know, for somebody right now who's healthy and could get insurance and elects not to, I don't know that in 2014 and in the surveys we've done that a whole lot will change with that group, just because $95 or 1% of income isn't a whole lot, and it's definitely less than the cost of actually purchasing health insurance. So I don't know that changes things, but by the time we get here, I think this is the time in 2016 where you will start to see some of these folks out there who have decided to go without because they want to save their money and they're healthy and they feel fine with things, who start to say, maybe the $695 or the 2.5% of my income, yeah, it's still less than the cost of health insurance, but it's getting closer, right? Or the gap's thinning a little bit, and maybe you start to see kind of some movement at that point in time with folks who really feel they want to actually purchase a policy. So. Any other question over here? Okay. Closely kind of tied to the individual mandate are these health insurance exchanges, which, the exchanges are a place for individuals to go and purchase their policies. More than anything, they're actually a vehicle for the federal government to administer kind of the subsidies that are being made available for low-income individuals purchasing health insurance. And that's their major purpose, beyond even just providing a marketplace and being able to have the options and compare plans and those types of things. It's really a place for those subsidies to be administered. And so, anyways, the states all have their choice about whether they'd like to run a state-based exchange or whether they'd like to not build their own state-run exchange and rely on the federal exchange to be present and operating in the state. I show here 18 states have made the decision to do their own exchange. If you include the states who have actually formed partnerships with one another to run kind of partnership state-based exchanges, it's 24 states. And then obviously the additional 26, there's 26 states who are not building, creating, and running their own exchange. They're going to be relying on the federal exchange to be present in their state and available for kind of the folks in their state. They go effective January 1st, 2014, and we talked a little bit about the eligibility for these exchanges. This is really a place for somebody to go who's uninsured, self-employed, unemployed, or works for a small company, for example, who's not offering them a plan. And they're eligible to go to the exchange, buy their coverage there, potentially be eligible for a subsidy to offset some of the cost of that policy, and find their coverage on the exchange. Just so everyone knows, I mean, most everyone who's kind of tuned in here is based in Utah. Utah has their own state-run exchange, as you're probably familiar with. Nevada is another state that I think we have some folks from who also has their own state exchange that they're building and will go into effect. Arizona is a state that is not doing their own exchange. Arizona is a state that is going to rely on the federal exchange. Utah is a really interesting state, actually, though, because they're the only state that's doing it this way. They have a state-based group exchange, and you're probably familiar with it because it's been actually around for a number of years and an option for a number of years. But the name is Avenue H. But the individual exchange is something that Utah is not going to be building or creating or operating themselves. They're going to rely on the federal exchange for the individual component of this, but they have the group exchange. And they actually received an exception to kind of do this dual kind of this dual approach, and they're the only state doing it that way. All other 49 states are either completely independent group and individual exchange, or relying on the federal exchange for the group and the individual component. Utah is just in that position where they already had a group exchange. The HHS approved that as the exchange under the law, and they'll rely on the federal government for the individual exchange here in the state of Utah. Yes?
So when you say group exchange, does that mean like employers go to their exchange to get coverage for their group?
They can. It's an option for them, in addition to the options that are available outside of the exchange. And obviously all of the carriers offer plans kind of independently of the exchange. I'll tell you that the exchange here in Utah is one of 2 states that's had an exchange in place prior to all these other states who are building their exchanges for 2014. And it hasn't been a huge success, I think, for a variety of reasons. But part of the challenge with the exchanges going forward is just going to be some of the adverse selection that could take place against the exchange. So groups who have had a challenging time because of health status, etc., or individuals who have had a challenging time because of health status, etc., are now going to be going to these exchanges because they offer them a solution. But you are going to have a difficult scenario where there's no waiting periods, there's no pre-existing condition limitations. You can go on and off those programs when you can. And so the carriers that are offering their programs through the exchanges, what we're hearing from them is that you'll probably find them in most scenarios higher priced than outside of the exchange, just because of some of the dynamics that are happening there. But the small group exchange is something that employers can go to shop coverage. The individual exchange is something where individuals are going to go to shop their coverage independently.
But for the individuals that go to the exchange, are they going to be subsidized to make it affordable?
So there will be subsidies available up to 400% of the poverty level, which probably doesn't mean a whole lot to you, but essentially if you're an individual who is making more than approximately $45,000 per year, you're going to not be eligible for any exchange. And if you're at those levels or close to it, your subsidy is going to be, I would say, relatively small. If you're truly low income, meaning we come down the scale significantly, then there's pretty significant subsidies actually to make those plans affordable. And same thing for families. Only the numbers just for household income increase to, again, approximately between maybe $95,000, $98,000 per year. So if you're a family of 4, household income above those levels, no subsidy. Around those levels or close to some subsidy, but again, significantly reduced from that. Pretty significant subsidies to make them affordable for those individuals that are going that route as well. Yes.
Rich still had a question. So back to regarding the penalties, for the individual coverage, if someone doesn't have a refund, the IRS can impose and enforce the penalty, right?
It's going to be difficult. It's going to be challenging. They're going to make an effort to enforce the penalty. The IRS alone has hired about 17,000 employees to implement and enforce, the healthcare reform. So what they decide and what they're able to enforce, I think we'll all have to just wait and see. But it will be challenging. And I will say it's going to be very difficult, but if you have somebody who's not filing a return or, there are some exceptions or exemptions from the mandate. Very difficult to qualify for, not your typical situation. But if somebody's perhaps not getting a refund for that reason, they actually could be exempt or carved out from the mandate. Yes?
Question back to the subsidy. Do you have to be in the exchange to get a subsidy, or do you have it outside?
Yes, only through the exchanges can you receive the subsidy. Yeah, and again, that's one of the major purposes of those exchanges is to be able to administer those subsidies. And you're not eligible for the exchange or a subsidy if you have an affordable alternative option. So, so if you're part of a group plan that's qualified affordable, you're not eligible for exchange because you're in essence already receiving, you know, the same type of opportunity there. Something that's affordable, something that's qualified, and something that's going to be, you know, similar to, if not even better than, what would be offered on the exchange.
So if you're only on the individual plan, paying for it all yourself, skyrockets, have a hard time paying that with everything else. Can you go to the exchange?
As long as you're not employed by an employer who's meeting their minimum qualifications and offering you something that's qualified and affordable. On the exchanges, they'll be very standardized plans, so the carriers that are participating will be offering four levels of plan: bronze, silver, gold, and platinum. Bronze being a very kind of basic entry-level plan. You can see 60% plan is what they're referring to it as, and that's again when we go back to the minimum essential requirement of having a 60% actuarial value. That's going to be kind of like the bronze plan. You'll have a 70% plan, an 80% plan, a 90% plan to choose from. I think I'll kind of skip through our timeline here because we've talked about the major kind of the major items on all of this. You know, jumping back to the very beginning again and thinking about the employer mandate, thinking about the individual mandate, and thinking about the benefit mandates. Just to kind of put it on the timeline for you, the individual mandate takes place January 1st of 2014. The benefit mandates that we kind of talked about, those will take place in 2014 as well, whenever the anniversary date of the policy or the plan is. So if it's a January 1 plan, it'll happen January 1 with those additional benefit requirements in 2014. But if you have a December 1st program, then you will have those benefit requirements not take place until December 1st of 2014. And then on the employer mandate portion of things, again, that was the piece of the law that would have gone effective 2014, but was delayed 12 months and will essentially be enforced starting January 1st of 2015. There's other kind of details in between. The most kind of up and coming requirement of all employers is to offer by January 1st a notification of the exchanges to all of your employees. So again, if you're not aware of that, you probably should be. So talk to your benefits advisor because you need to get out a notification of the exchanges. It basically is something that says what they are, where you can find out information, you know, what the purpose is, and then some information specific to your employer-based program that will kind of determine the eligibility for that person for an exchange. But that was something that originally in the law was supposed to be provided to employees in March of this year, and because the information about the exchanges was not available or ready to be distributed, it was delayed, and then the new date that's been set is October 1st. And that's kind of the next up-and-coming piece that everyone needs to be kind of compliant with and aware of. And then things here and there. But I've tried to kind of present this to you in a way that we're covering the high level, the major topics, giving you an overall sense of what this law does for benefits, for health plans specifically, which I think is most important to all of you, and what it means just in terms of some of the dynamics with the exchanges, with the pricing on health plans, with the reporting and with the pieces that both individuals and employers need to be aware of and compliant with to avoid unnecessary penalties. And so hopefully it was helpful. we do have time left that I want to take any additional questions that you have, anything we haven't covered, something else that that you're thinking about. But after questions, feel free to grab some cookies. We have some little trinkets, and I think someone's probably going to do the, or is that going to be after the fact that they do the raffle? So what other questions do you have? Yeah.
Do you have the website or whatever to get to those changes and get the information to provide?
So the Department of Labor has come out with a form that you can go onto the Department of Labor website and pull from. But also, if you're working with a benefits consultant or advisor, you don't have any. Yeah, so you can pull it right off the Department of Labor's website. There will be on the last page some specific information that you need to complete relevant to your organization, basically identifying that we don't offer insurance, that type of thing, and that you can distribute by October 1st. Another question over here.
Are you seeing that health insurance providers are going to be providing the total cost of an employee's premium to the employer at the end of the year, or is that something the employer needs to be continually calculating?
On a fully insured plan, it's something that they will build into their rates at the beginning of the year and obviously assessing throughout the year.
Right. So for reporting purposes, are we going to, from a W-2 standpoint, is it going to be something they can easily request from their health insurance provider?
Yes. Yeah, something that you can easily request and even easily calculate as well. Basically what you're going to do is you're going to take employee X and you're going to identify, do they have coverage? If yes, single coverage, family coverage, what is it? What's the monthly premium? Were they on the plan for the full 12 months? If yes, take that monthly premium times 12, and that's the value that you're going to report on the W-2. If you're self-funded and your costs are more variable, the IRS has come out and instructed us to use the COBRA rate. So we're basically taking the identified COBRA rate and doing the same calculation for the purpose of reporting the value of the plan on the W-2.
Chris?
Yeah.
This has to do with the non-discriminatory provision, the 9.5%. Some employers use a incentive compensation plan where they'll do an evaluation of their employees, they'll rank them or grade them or give them a score. And in some cases, they will want to use that score as the basis for covering more or less of the benefits. Does that create any problems with regard to numbers?
Yeah, 1 second. Repeat. Yeah, sorry, thanks. So the question is for an employer who is doing some type of performance review, some type of scoring or grading of employees and using that score to determine what someone's going to be required to pay for health insurance because they're going to provide an incentive or a difference if you're ranking high on your evaluation. I would steer clear of it only because it could potentially create an issue. In and of itself, it's not necessarily something that you can't do, but what happens again is that you're going to, because you're doing something kind of unique around your contribution structure, you're going to want to be very diligent in completing one of those discrimination tests each year. And those discrimination tests, they're not they're not unaffordable, but there is some cost to having somebody do that. And then you could potentially find yourself in a given year in a position where you're out of compliance with Section 105H of the Internal Revenue Code, meaning you're discriminating against your lower income folks. And you're not doing it purposefully, but as they kind of do the testing that's required, the evaluation that's required, they're finding that for whatever reason, it's your higher paid employees who are scoring higher on your evaluation and getting a better deal than the lower paid employees. And it's usually not purposeful, but you got to be careful going forward that you're not favoring the highly compensated in the organization. And that's where I would see that becoming potentially an issue, but if nothing else, something that now you're having to be very diligent about checking and being aware of that might not be necessarily worth what you're doing. If you could move that so that you're just incentivizing in the same way, but not on your health insurance premiums through some type of other reward or incentive, pay, vacation time, gift card, I don't know what it would be. You would at least kind of just avoid kind of the possibility that you run into trouble. Yeah, question from.
Listen to Richfield. Regarding the individual coverage, the max penalty for not having coverage is 3 times the number of adults, right? Does the 1 or 2% of household income trump this max penalty?
Yes. Yep, the higher of the two. So if you're a family of 3, a family of 4, you're talking 2.5% of household income. The question getting back to the penalties on the individual mandate, and again, it's going to be the greater of the two. So even if you're a large family and you're only looking at a cap of 3 on the $695 in the third year and beyond, the 2.5% of family income is going to most likely be something that's greater than that and going to be ultimately what's paid. Yes.
Does a small employer have to send out that letter that you were talking about earlier?
Yes, they do. This is one of the pieces that whether it's going to be enforced and how it could be enforced is one thing. But all employers are supposed to be sending out the notice to all employees. So not just employees on the health plan, but to all employees too. And more than just being required by the law to do it, this is one of the pieces that's kind of a nice thing, just because you're providing the information and the education to your employees, which is a good thing anyway, so that they don't find themselves in a position where they don't understand or are surprised or whatever the case would be. But yeah, everybody should do that. Yes.
Would that website that you gave me provide a template for a letter that
Yes.
send out?
Yep. The Department of Labor has a template that you can use and you can send out. So. Yeah.
Currently, it said, are small businesses responsible for anything other than issuing notification about exchanges?
Not a whole lot, no. Maybe some additional education for employees would be helpful, but not required. But they're not subject to penalties under the law. So, a lot of small businesses they find this very important because they're trying to align themselves and their plans and their eligibility requirements and everything else with kind of what the trend is and what the market's having to do, just because they don't want their employees to necessarily be in a position where, well, everyone else is doing this, but you're not. Well, it's because we don't have to for this or that reason. So I think it's worth knowing the requirements so that you can decide whether you want to maybe do something that's not required just because it's something you find attractive to do, or everyone else is kind of doing it. But you're not subject to the penalties as an organization if you don't comply with the other pieces of that. So hopefully, yeah, that helps. Yep.
There is a requirement to provide a detailed explanation of benefits that wasn't the same principle.
Yeah, really good point. Thanks for mentioning that. So there's a uniform explanation of benefits that probably everyone has seen now, but that's required to be provided to employees of any plan, small or large group. But it should be something that your health insurance provider is providing to you if you have a plan in place, and you're basically distributing that in lieu of a summary of benefits or alongside a more traditional summary of benefits. But very good point. You do want to be providing that SBC to your employees and to new hires who come into the company. Yeah.
On the exchange, I know you said that the employee could be ineligible if the insurance plan may offer the 9.5% or less, and the dependents could be eligible for the thing. But when you're trying to determine if your dependents are eligible for the exchanges, are you still looking at only the single coverage at being 9.5%, or can you actually look at what it would actually cost you to insure that?
You're basically looking, so the employers met their responsibility, but now you're looking at what is my option for family coverage,
yeah,
and what is that as a percentage of my household income. Okay. And if it's still lower, then you're going to find yourself ineligible. But if it's not, for those dependents, when you include them in the equation, then they'll be eligible.
And is it based on the base plan or the plan you'd actually purchase?
It's based on the base plan. It's based on as long as it's a 60% plan, as long as it's a minimally compliant plan, then it's whatever it would cost to get onto that plan.
Okay, so a person in their family, just to make sure I understand, if the cost of the base plan exceeds 9.5% of their household income, then the dependents would be eligible for the exchange if the employee-only base plan is qualified and less.
Yep, that's right. Yep. Yeah, and I'll tell you, one of the things that some employers are doing is they are, it gets complicated because the individual requirements are different than the employer requirements. So some employers are offering a plan that's compliant, but they're saying, we're going to offer another plan that's not compliant. But we've met our responsibility because we have a compliant plan, but we also want a super high deductible plan, a cheap plan. We're going to offer it because it's more cost effective. The employees still want that option. But the employees have to have a qualified plan. And so it gets a little bit gray in terms of, people could get confused about, is this a plan that works or not work? Because the employer only has to offer one plan that's compliant and that passes the test. But they could have other plans that do or don't. So,
and generally speaking, when they're going to offer a dual option like that, the carriers, to this point, they're not going to allow a big disparity between what the actual plan is being offered and the other. So they couldn't be offering a plan that's super rich, really low deductible, fat benefits, and then a very, very thin plan otherwise. There's usually going to be some sort of a 5% rule that's saying you can have dual option, but you can't have like the Cadillac plan and the Yugo plan. And that's what you're offering. Usually they're going to try to keep them things.
If we can be helpful in any other way, I have Daniel's contact information here. I have my contact information here. One of the things that we do out of our office is we produce these kind of healthcare reform updates and just information, educational pieces. These just go out on a distribution list. If you want to, I have a few copies of some of them, not enough for everybody, but if you want to put your name and email address to receive these, more than happy to get you on the list and send these out. If we can be helpful in answering other questions for you, we want to do that. Again, this is all made possible by Hinton Burdick, and we appreciate what they've done on this. And Dean, do you have something you want to?
We plan to put this presentation, we've recorded this presentation, and we plan to put it and the PowerPoint presentation on our website. But if you want us to email it to you, you give us, one of the Hinton Burdick people, your business card, or send us an email, and we can email you this PowerPoint presentation too. And Chris, you might want to mention, they probably didn't hear me, so if you want to
yeah. Yeah, so Dean at Hinton Burdick had just mentioned that we're going to make this presentation available. If you want to provide to any of us your contact information, email address, we'll make sure you get a copy if you otherwise don't have it. And I think with that we'll wrap up. I hope this has been informational, educational, helpful. I know everybody came into this with a little bit different level of understanding, but hopefully you learned something new. And we'll stick around for a few minutes. Like I say, jot your email down address over here if you want to get on the distribution list. And thank you for coming and for participating today. So.